Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out those charts that really seem to be saying something right now. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. We're seeing the market shifting and looking a lot more positive longer term. We held with support. We've seen a nice move up with the S&P and the other indexes, and things are switching back more positive, but we're looking a little bit overbought in the short term. We were looking overbought a week ago, and the market was looking a little bit exhausted, but it shows good resilience in that we just kept going up. Now we're looking even a little bit more overbought, so we want to ask the question, will the S&P 500 keep climbing despite being overbought? This is being prepared for Monday, May 19th. What I do is I break these down into three categories. Those things that are positive, and it's a pretty long list this week. Those things that are negative, and even some of the negative things are improving. And then the last area, what are those things that we're just watching? Just to see. They're usually outside of the S&P itself or even outside of the stock market. And we just keep an eye on those things because they can have an impact on stocks. All right, so let's go through some positive things. The first thing is sentiment. Now, it seemed like for a lot of March and pretty much all of April, we were camped down below 25 as far as sentiment. That means there was a lot of fear in the market. What was different about this is that usually when we come down and we get below 25 or below, right around that area, that usually means some kind of capitulation. And then we just bounce up out of that. Everybody freaks out. They think the market's just going to keep going down, but then it ends up doing the opposite. Well, this time was different. We came down and we just sat below this 25 level for a long time. Finally, as we started coming up out of the low that was set now in early April, and we only know that from hindsight. We can only look back and go, oh yeah, I guess that was the low. It sure didn't feel like that at the time, and there was a lot of variables out there suggesting that we could still go lower than where we're at right now. But we did hit some support levels, and we were able to bounce up off of those. As we've been coming back up, sentiment has been getting better. We tend to go with this. Now, when it's extreme negative, we take a contrarian attitude with that. Everybody's negative, so we start looking to be positive. And then we just ride that as it's going up. So we're positive too. Positive, positive, positive. Now we're starting to get to this point at 75 or right around here where this is maybe when the market is getting a little too happy about things. And so right about now, and if we keep going up a little bit with this, this is when we start to take a contrarian view. But just like we camped down here with the contrarian view that, okay, but we just stayed down here, there are times when the market is quite positive when we can stay up around the 75 level for lengthy periods of time. So it's not like we immediately take a contrarian view just based on this chart. We look at other charts and say, okay, it looks like we're overbought, but we're not going down yet. So then we look at other charts. Okay, we're starting to go down if that ends up being what happens. And then we see a gradual deterioration and we start to go down. Then if we do start to go down, that's when we evaluate things day after day after day and say, okay, what's the condition of this decline? Are we just pulling back? Are people just taking profits before they're getting set to come in and do some more buying and maybe take things higher again? We won't know that until that actually plays itself out. So right now, I'm treating this as positive as far as sentiment, how people are feeling, but we're getting close to that level where we're becoming exuberant. All right, another thing that is still positive, this is an intraday chart of growth versus value. We want the blue line above the red line when we're more positive. And as we've been bouncing back up, there's been times when they've kind of kept pretty close to each other. But for the most part, especially lately, we're seeing the blue line above the red line. That means growth is outperforming value, and that's more positive. Also, we look at a growth to value ratio for the S&P intraday, And after we started coming back up here, I colored this green. Now we've been falling back a little bit lately, so we'll keep an eye on that. But when you look at the bigger picture, we have been going up with this chart. Then we look at end of day charts, and now small caps, they're still negative, and they still have a lot of damage left to repair. But their growth to value ratio is looking pretty good right now, as is the mid cap growth to value ratio. The mid caps finally got above their 200-day moving average. Small caps haven't done that yet, but we are seeing some signs of improvement there. And we're still in a downtrend with the S&P growth to value ratio end of day chart, but we're above both moving averages, and we are really showing some signs of improvement here. And we look at a growth versus value ETF. We had spent quite a bit of time underneath the rainbow, and the rainbow was starting to get all jumbled up. Now we're starting to come back up on the other side of the rainbow, and that's looking more positive. Then we have a number of different growth to value ratios. Qs to S&P, discretionary to S&P, large cap growth to large cap value. Even though they took a bit of a hit on Friday, they're still above advancing moving averages. So this is showing more strength, at least in the short term. And then we look at the large caps, mid caps, and small caps, also still above advancing moving averages. Large cap growth ETF, we had fallen below all the moving averages. Now we've reclaimed those. The longer we can stay above these moving averages, the more they will turn up. Then we look at discretionary versus staples. I do a ratio between the equal weight versions of those sectors. It's in a downtrend, but really starting to come back up. We're seeing discretionary improve quite a bit, coming back above its moving averages, where staples had pretty much been going sideways. And while discretionary was going down, that's why we saw this ratio going down. Now we're seeing discretionary take a little bit more of a leadership role. Then we look at the chart that I just showed, discretionary to staples equal weight. Well, up on the top, this is the regular sector ETF for discretionary to staples. When we're going down, that means the market's getting more defensive. And that's what was happening in April and into the early part of May even. But then March going into April, then the latter part of April going into May, we've been seeing a bit of an improvement here where we were getting more defensive. Now the market is starting to get more offensive. And we see that across a number of different sectors. I already talked about the discretionary staples equal weight. Well, we look at the tech sector, which is growth to utilities, which usually is considered to be value, had been getting more defensive, now is becoming more offensive. Biotech, which is growth, versus healthcare, which is defensive, starting to see an improvement there. Hotels, which are discretionary compared to utilities, something you have to have, this has also been improving for the most part. We look at some real key industries within the U.S. economy, and semiconductors are still in a downtrend, but they've been improving. Home builders showing some improvement there. Transports, also a little bit of an improvement. Retail improving, and regional banks. Now, they gapped up on Monday, and I'll show you another chart of this later on, and we've just been going sideways ever since then. Even though a week ago the market was already overbought, the fact that these are holding up better, that just shows that there's some strength in the market for right now. We look at a ratio between high beta stocks. These are Apple, Google, Nvidia. The stocks that tend to outperform the market when we're going up. Unfortunately, they go down faster when the market's declining versus low beta stocks, toilet paper, toothpaste, the things that people have to have. When this ratio is going down like it was in March and into April, that means the market was getting more defensive. We've been seeing this ratio now bouncing back up, even though we did come down on Friday. Momentum stocks. This uses some different criteria to pick out what stocks are showing good upward momentum. Now, the interesting thing about this is we actually saw a positive divergence even when the markets were really under pressure. We set a low here in March, and then we came up off of that. And then when everything was going down and we hit the low around April 6th, 7th, 8th or so, this set another low, but it was a higher low. So that was a little bit encouraging at that time that we were seeing a positive divergence here. That gave us a little more confidence that maybe the bounce that we were coming up out of might have been the bounce, the bottom for at least right now. And then since that time, we've been seeing momentum stocks actually outperforming the SPY, which is the ETF for the S&P 500. This chart is positive. And then for a lot of 2025, And a lot of people are starting to do this now that it's probably about over. The ratio between US stocks and international stocks, this had been really going down. Well, right about in here is when people say, oh, I'm going to take my money out of US stocks and put them into international stocks. Unfortunately, when people don't really focus on the market or look at charts like this to help them make decisions, they just hear about it in the news or talk about it to a friend. That's not a good way to make decisions. And this ratio is starting to go back up. Now, it could, of course, go back down. Doesn't mean these people are always wrong, but they tend to be wrong and they tend to arrive late at the party. But we're seeing a general shift. Now, this is not a trend line. This is just to accent the fact that we've been going down here. So it's not like we're breaking out against anything. This breaks about every trend line rule that there is in technical analysis. I'm just trying to accent that we were going down and now we're starting to go back up. We'll see if this chart continues to improve. Also, emerging markets, these are other countries where they're not as developed as, let's say, Western Europe or the US. The emerging markets had been underperforming, not improving as much, and came down a little bit on Friday, but we'll see if this chart starts to show a little bit more of an improvement. And then value, which the market really gets into those things, toilet paper, toothpaste, when the market's getting defensive. As we were going down, this ratio was going up when we compared to tech, which is, of course, is growth, and that was more negative for the market. Well, now we've been seeing this ratio really coming down, and it will be more positive if this ratio continues to fall and we stay under all these lines, and then the lines begin to go down with more of a trend than what we're seeing right now. The VIX finally went under 20, and that's a good thing. Usually when the VIX is under 20, that's when we see positive annualized returns. But in here, we're still going down. The momentum of the VIX is down, but, okay, I'm not quite at the but yet. It's on the next slide after this. This is when we do see the positive returns. The lower we go below 20 with the VIX, the higher the annualized returns become. When we're above 20, that's when we see negative annualized returns. And this was a chart put out by Tom Bowley at stockcharts.com as well as earningbeats.com. This is the but that I was finally trying to get to here. I use an RSI based on 9 periods, and we've been coming down pretty fast with the VIX, maybe a little too fast. And so when we get to an extreme low reading like this, that means the VIX might have been coming down too far, too fast, and it might be due for a bounce up here. And that's part of this overbought condition that we're dealing with right now. We're seeing an improvement with the risk on to risk off ratio. When this ratio is going up, which is what it's been doing, that means the market's more risk on and they're willing to jump in there and buy the riskier stocks. Also, we're seeing an improvement here. When we look at the spread between risky and not as risky bonds, this ratio continues to go down. Now, the next chart, it's the same thing, but inverted. We're actually going back up here, which means fear is coming out of the bond market, and that's positive for sentiment for the bond market. And we look at the condition of the trend. We're possibly just beginning a new trend because the ADX, that's what I use here. That's the black line. It finally crossed above its moving average after it had been going down, down, down. That suggests a weakening trend. When we cross above the moving average, that means the trend is starting to get stronger. It won't be confirmed until we go above this blue line, which is 20, but we can still treat it as being positive right now. And it's also positive because the green line is above the red line. Then when we look at the intermediate term trend, and this is the one that I focus on the most, we're starting to cross above the moving average. You can see the numbers over here on the left. The value for the ADX itself is a little bit higher than what we're seeing for the moving average itself, but we're still below 20. But we're going above the moving average. And if we can stay above the moving average, cross above 20, that would be a confirmed trend. And it would be positive because the green line is above the red line. Long term, though, we're still negative. But we are seeing it slow down a little bit. The ADX is starting to roll over, but it hasn't crossed below its moving average at least yet. But the red line is above the green line, even though the red line's coming down and the green line's going up. This is still treated as negative. It's still a strengthening trend until the ADX actually drops below the moving average. Then we look at the condition of our smart money indicators, and I have 3 of them, and then I'll have a weekly one to show as well. This is a daily chart of accumulation distribution. How we look at this is when we're above the red line, that means we're positive. Okay, so we're above that. And the red line itself is actually going up. That's even more positive. Then I have a thing down here called the boom indicator. And when we're going up, which is what we've been doing, and we're above the moving average of the boom indicator, that's a little bit more short term. It's a little bit more aggressive, but as long as we're still above this moving average, it's still considered to be positive. So we're seeing a little bit more of a confirmation here. So this chart is positive. This is a weekly chart looking at accumulation distribution. We're also above the moving average, and the moving average is going up, and the boom indicator is going up. So even longer term, even though we're in a downtrend, when you look at the weekly charts, we are still positive here when we look at accumulation distribution. And here's back to a daily chart of the second smart money indicator, the Chaikin money flow. The histogram is going up and the red line's going up. That's positive. Then the third indicator, but we want to be careful here. This is the Chaikin oscillator. We're going up and we're above the moving average, but we're getting close to this green line. And you can see other times when we hit that, it didn't necessarily mean a reversal, but it did mean that we might slow down for a bit. But for right now, the three smart money indicators are positive. Vortex, green line above the red line, that is positive. The parabolic SAR shows the dots underneath. This is a daily chart. That's positive when the dots are below the bars. And for the second week now, we are positive with the weekly parabolic SAR chart. And here's just a daily chart. We had been coming back up. We finally got above the 50-day moving average. And then after the news came out last weekend about the trade talks between China and the US, the market really liked that. We actually gapped above the 200-day moving average. We had been trying to get back above that. And then we were running into this previous pivot point here, and that was acting as overhead resistance. Well, we were finally able to break above that. So we're seeing a market that is still going up despite being overbought. You've got a lot of people who don't believe the market's going to go up, and that helps the market go up. And so this is showing some strength. Now, there's one thing that's a concern. If you look at the bottom, the last number of days, we've been below average with volume. Now, Friday was options expiration, and that's usually one of the heaviest volume days of the month. Now, we actually saw volume drop off on Friday. So that's a little bit of a concern. That usually you want volume to confirm what you're seeing with price. Now, there's other charts that we look at that show volume being actually stronger than price right now. It's actually the leading price, and that can be more positive. And I'll point that out as we go through here. But a classic case of technical analysis is when we're really going up, you want to see an increase in volume. And then if we start to go down, that's when you want to see a decrease. Now, that's the logical side of things, but the market has its own version of logic, and it doesn't always stick to that. Okay, then we look at the bullish percent index. This is a little bit of a concern, even though it's positive. We're above this green line, but we're starting to come down. And both in Thursday and Friday's session, we saw the bullish percent index start to fall, and it's actually dropping below its moving average. So that way, you could actually say we're negative here. The reason why it's on the positive side is because this was really going up, and it's above the green line. Now, one thing to make note of, even before we really started to see price go up with the S&P, as we were getting a very low reading down here, the bullish percent index was improving. We weren't seeing it yet based on price, but this chart was actually looking more positive. So let's take that same basic idea. This is showing a little bit of weakness before we're actually really going down based on price. We just want to keep an eye on this, because if this continues to fall and we see a little bit more of a pullback, this could be telling us that the market's getting exhausted. And then, as I said, if we do start to see some declines, we'll just evaluate them as they occur, see if this is really turning more negative or if it's just looking like a pullback. And we're also really extreme but positive with the bullish percent index for the NASDAQ 100. Now, this is where we're seeing some improvement when we look at the advanced decline line studies. This is a cumulative advanced decline line for the S&P based on price, setting a new all-time high. We have not set a new all-time high with the S&P. So that's positive, the fact that this is going up and setting new highs. And then volume is even doing better. It's setting an all-time high as well. This is the cumulative volume for the S&P. Then another thing is the stocks above their 20-period moving averages that are in the S&P. When we get above this 80% level, we're getting pretty extreme there. And again, it doesn't necessarily mean a reversal. It can, but it doesn't always mean that. It could just mean that we're getting exhausted, but we're getting a very high reading here. And then we're really seeing an improvement in the intermediate term. We were having a really difficult time getting back up to 50 with the stocks above their 50-period moving average inside the S&P. In fact, if we go above 80, that would be an extreme reading for this particular study. And we're back above 50 with the 100-period moving average study and 200-period moving average study after spending quite a bit of time below it. So that's just showing short, intermediate, and somewhat long, and then long term, we are seeing improvements across the board from a moving average perspective. We're also setting new all-time highs with the advanced decline line based on price and volume, even though we have not set an all-time high yet based on the S&P index itself. Now, this is a bit of a negative divergence, even though this is positive. This is the last 10-day simple moving average of advancers minus decliners. We're doing really well and going up, and this is actually setting lower highs here, even though it's above zero, so it's positive. That's why it's on the positive side. But when we get above the red line, a week ago, we were looking extreme here. We pulled back, but then we started to show some strength. Well, as the week unfolded, this was actually giving us lower readings. So that's a bit of a negative divergence there. But we're looking better with the new highs, new lows. This is the internal look inside the S&P. We were getting discouraged that we were seeing not much green and more red. Well, now we're starting to see more green and not any red at all. And so we're starting to turn back up with our 5-day moving average. And the 10-day is just barely starting to turn back up. Now, on a short-term basis, the blue line, the advanced decline ratio, this is based on 19 periods. We're going above this green line. Now that means it's positive, but that's usually when we start to look a little extreme positive, meaning that we're overbought. But we're looking better here with our advanced decline line studies. You look at the common stock on the NYSE, the S&P, mid caps, small caps, they're all above their moving averages. And in some instances, the moving averages are starting to turn up. So that's just showing more broad market improvement. Now, here's a cumulative advanced decline line for the NYSE, setting an all-time high, but we're not at an all-time high with the NYSE. We're also setting it based on the advanced decline line. This is a regular advanced decline line, but that's really good for the market overall. This is another NYSE advanced decline line, also coming in and setting a new all-time high. And this chart and then the previous one, they're calculated in a little bit different way. That's why I show both of these charts quite often. And then we just look at common stock. We're not back to an all-time high here, but we are improving. We are setting a new all-time high, though, with the common stock on the NYSE based on volume. This is one of those charts that could be showing that volume is actually leading price. Looking better here. Now, this is, I always say this is an apples to oranges comparison. This is the S&P index, the bar chart, compared to the NYSE advanced decline line. We look for any real divergences or what's above the other, even though they're on different scales. They're pretty much moving in lockstep. In fact, the broader market is actually outperforming the S&P just a little bit here. I wouldn't read too much into that. Mainly, we just want to see, are they tending to go in the same direction? And they're still fairly close to each other. But we are getting a little extreme in the short term with the exponential moving average based on 20 periods for the S&P. We're getting above this 80 level here. We're just barely getting extreme in the intermediate term. We're above 50 and advancing with the long term. CMB composite, another oscillator. When we get above this black line, that means we're extreme positive. We've been above it now for a number of days, and we're finally back above the 200-day moving average. So things were more negative when we were below it. Now we've been able to reclaim that. And we are positive with the Landry light. We're seeing green as we've been going up, and the proper order also has the background changing to green, which is positive. Now, the TTM squeeze, yeah, it's positive, but man, look at how high of a reading we're getting here, higher than what we're seeing on this chart, and this is a little bit longer term. This goes back about halfway through 2022. So, yeah, we're getting a little overextended with this oscillator, but we're positive here with the bow tie. We're above all three lines. When the fluorescent green line is above the red line, which is above the blue line, that means that we're trending up. And I mean, doesn't take a real genius to see that we've been going up, but this is just another way to spot potential support or resistance areas with this study. The condition of the short-term trend is still strong. We're seeing the green line above the blue line and everything is going up. The intermediate term trend also improving. We're seeing the red line starting to cross above the blue line. That shows there's more strength. The red line moves faster. And so when it starts to come back above, that means that there's a little bit more conviction in the intermediate term. And we're above all the plotted moving averages. It looks like a spaghetti mess here, but the longer we stay above all these lines, the more they will start to turn up. Then another way of looking at a long-term view of moving averages is a rainbow. This is short term where it goes from 10 periods up to 50 periods, even though it's a longer term chart. We're back above the rainbow and the lines are starting to turn up. So this just shows that the short-term trend is really improving. We're also back above all the lines, but they haven't really started to turn up yet when we look at the intermediate term rainbow. And then a long-term rainbow, we weren't below it all that long. The lines were starting to roll over, but now we're getting back above the rainbow. This is showing longer-term improvements as well, but we're far away. The boom indicator tries to measure how far away are we with price relative to the 20 or 50 or 200-day moving average. When we get a real high reading like this, that means we're really far away. And the moving average tends to act like a magnet or a leash on a dog. If it gets too far away, you pull the dog back. We're way far away. We're out in the bushes right now with the short-term moving average. We're also quite overextended with the 50-period moving average. We did cross back above zero with the 200. That means we're positive longer term, but we're not extreme when we measure the distance from the 200-day moving average. And we were able to get back above all these anchored moving averages here. We were using them as support on the way down. They were acting as resistance at times on the way back up. Now we've been able to clear them. The last anchored moving average here is back to the all-time high set in February. Excuse me. We had enough of an upward move on Friday to draw in a new X. So we had been in this box for a while. This is when we were going down and then we were chopping around all over the place. We've seen X's, then O's, XO's. It's like a love letter here. Finally, we were able to break out and set at least another intermediate term high with a new X being drawn. And this is a triple top breakout that was generated back on April 25th. We were having a hard time breaking above this 54.50 level. We finally did. And that's when things really started to look more positive. And that was what, 500 points ago? Wow. Okay, the rate of change going back 5 periods, that's the change on Friday to 5 days ago. That's still looking extreme, and that's short term. Then we have a little bit longer to almost intermediate term, a 20-day rate of change. That's still looking pretty extreme. And we're actually a little bit above the +3 channel with our standard deviations chart. That doesn't happen very often. This just means we're overextended to the upside, but we are positive since we're above the midpoint and everything is going up. And then the S&P McClellan oscillator is starting to look extreme. Okay, now you could make a case for a negative divergence here where we set a high and now we're going up with price and we're setting a lower high with the McClellan oscillator. Okay, yeah, you could suggest that there's some weakness coming in here, but it's still positive overall. And when that's positive, the summation index is continuing to go up based on price. We're going up based on volume, but we're getting near this red line, which could be an extreme line. Now, even if we decline with the previous chart, the S&P McClellan oscillator, as long as we're above zero, the next chart, they will continue to go up. They don't turn down until the McClellan oscillator drops below zero. So we could get to an extreme reading here, even after having a couple of down days. And then the NYSE McClellan oscillator. If you remember back over here, we're crossing above this 80 level with the S&P. We're not. We're seeing more of a negative divergence. We've been going up with the S&P where the NYSE McClellan oscillator has not really been showing as much strength. But we are positive here with the Swinland trading oscillator. We're turning back up based on price and volume. And we're a little extreme. Now, there's a thing called the PMO. It's a momentum oscillator developed by Carl Swinland. And what he did is he put PMOs on every stock in the S&P 500, and then we can measure that. Well, these are the stocks inside the S&P that have PMOs that are rising. That's getting extreme. The PMOs that are generating buy signals, that's getting extreme. The PMOs that are above zero, it's improving and it's above 50. So that is still just positive. Momentum, we're looking positive, and in the short term, maybe real positive here. The slope oscillator, but it has been giving. We were concerned about it when it was back down here. Now it's going up even higher. So this just means in the short term, according to this indicator, that we are overextended to the upside. Now, the other short-term oscillator, the TSI, it's above the midpoint and going up. It hasn't become extreme yet. That's why I use more than one oscillator. Then I have three intermediate-term oscillators. You could make a case that the MACD is starting to look extreme. That's a higher reading than what we've seen over the last year. The PMO, getting close to that extreme area. And then the PPO, yeah, that's starting to get extreme there. And then I have two long-term oscillators, the TRIX and KST. This is starting to get extreme with the KST, where it's still looking positive with the TRIX. Topic curve, another momentum oscillator, getting quite high readings right now, but we have been for a while. And then with the RSI, the short term, based on 9 periods, we're above the 70 level. That means we're extreme. We're just on the border with the intermediate term. If we still have another up day or two, this will probably go extreme positive as well. Ichimoku cloud, we were finally able to get above that. This is what happened after the gap up on Monday when after the news came out. So this chart is really improving. We see the green line in here, which is hard to follow because it's mixed in with all this other stuff. That's short term, and that's going up. And then we have the blue line above the red line, which is positive, and everything is going up, and we're above the cloud. So this chart just a week ago was looking somewhat negative, is now turned over to positive. This is longer term. We were able to get back above this pivot point. We stayed above it. We gapped higher in this week, and we went up. We had a really solid week. We were up 5.25% for the S&P. So this is looking a lot better longer term. And then we look at the S&P weighted index. That's the one that you hear about versus the equal weight version. That's where all stocks are treated the same. Both are going up, and that's encouraging. We're not really seeing anything outperforming all that much. Now, when the market really, the S&P anyway, really starts going up, we will see the bar chart actually outperform the equal weight version or the red line here. That just means that the big Magnificent 7 stocks or Mega Cap 8 or Illustrious 11 or whatever group you come up with, that just means they're outperforming. And then the Dow finally was able to get back above its 200-day moving average, which had been acting as overhead resistance. And then in Friday's session, it's actually back to being positive on the year. It had been negative for 2025. When it reclaimed the 200-day moving average, it actually is positive, even though it's still in a downtrend. We still have the 50-day moving average below the 200-day moving average. And we're still in a downtrend with the NASDAQ, but showing a lot of improvement in getting back above these moving averages as well as pivot points. NASDAQ 100, which we really follow that for the S&P 500, above the moving averages, which have been acting as resistance, got above this R1 level, not at an all-time high yet, but looking pretty solid for the time being. Momentum for the NASDAQ 100 is positive. Even the small caps are showing some improvement, but they're hitting overhead resistance right at this R1 level. They're still negative longer term because they're below their 200-day moving average, and they're still in a downtrend. It's going to take a lot more improvement than what we've seen so far for this to turn back to positive. Here's the other small cap index, the Russell 2000, getting extreme already with the RSI. We're above the 50, but below the 200, and the momentum is positive. Mid caps, we're able to get back above their 200-day moving average. So now they're positive longer term. Not positive year to date, though, but showing some improvement along the way here. Now we need the mid caps and the small caps to show some more strength to help the market be more positive. Financial sector came close to generating a death cross here, but we've been coming back up. We're above both moving averages, and we're not quite back to an all-time high yet, but this chart is really improving. And then the bank ETF, this is inside the financial sector. We are still in a downtrend, but we gapped higher with everything else. The only problem is, well, it depends on how you look at this. Here's where we opened on Monday, and we were barely up by the time we closed on Friday. We went sideways. Now, as I said, even a week ago, I was saying the market looks overbought. The market looks overbought. We're hitting resistance. Well, we just busted through that, and now we're more overbought. But the fact that this is holding up, in spite of being overbought in the market as a whole, that could be taken as positive as well. It's negative that we chopped sideways when the other indexes were up, but it's positive in that it's holding up in spite of an overbought condition. Wilshire 5000, broad market measure, back above both moving averages, even though we're still in a downtrend. The same thing here with the total US stock ETF above both of the moving averages. The FANG index also still in a downtrend, but really improving. It had a good Monday and Tuesday and then just kind of didn't go much of anywhere for the rest of the week. We want this ratio to go down if we're more positive. This is staples to tech. When this is going up the way it was in February, March, and into April, that means the market was getting more defensive. That means toilet paper and toothpaste were outperforming the tech sector. Now we've been really coming down. Now, it took a bit of a hit. It's off of this low that we saw right here. We want this to continue to go down to be more positive, the way it was back in 2023 and about most of 2024. If this ratio could continue to really decline, that would be a lot more positive for the market. We do that same basic thing, but instead we still take staples, but now we look at the S&P itself. This has been really coming down. It went back up a little bit later in the week, but if this ratio continues to fall, that would be more positive for the S&P. We still have a ways to go here with the NASDAQ 100, but we are improving with the long-term trend. We're still looking positive with the ratio between the NASDAQ 100 growth and the Dow value, even though there's Nvidia and Microsoft. There is growth in the Dow, but this ratio is still holding out above this red line, and that's positive. It's not breaking down like what we saw back with the dot-com bust. The small caps to NASDAQ 100, this is just doing well. And again, the NASDAQ 100 or the QQQs are improving, and even the small caps are improving, but not quite as much. And that's why we're seeing this ratio really going up. Then this is, what does the market think? Are we going to go into a recession or not go into a recession? When we're above the rainbow, that means the market's anticipating a soft landing. And for the most time, over the last couple of years, that's what we've been seeing. Well, that was all thrown into doubt with the whole tariff announcement and economic reports that the market didn't like and negative GDP. Well, now we're seeing an improvement here, and we're starting to come back above the rainbow. If we can go back up, see the lines in the rainbow turn back up, the market anyway would anticipate that we're not going into a recession. A recession then would be called a hard landing here. And then this is just an inverse of the same thing that we just looked at, where bonds have been underperforming and then they were starting to outperform. Now they're starting to pull back. Now you're going to see a lot of the same thing here. And it's not because I just want to show you the same thing over and over. I want to show you where the same things are happening using a variety of different indexes and ratios. This is the S&P 1500, a broad market measure to short-term bonds, 1 to 3 years. We were really collapsing here. Now we're starting to get back above the rainbow. We look at another broad market measure, look at further out bonds, same thing, collapsing, starting to come back up above the rainbow. The QQQs, the 3 to 7 year bonds, coming back above the rainbow. The tech sector, the 3 to 7 year bonds, a lot of improvement there. And this is one thing, and I've actually played with an idea of doing a video for YouTube and Rumble just based on this chart, because it was really looking like, okay, at the end of 2021, when we look at the SPY, which is the ETF for the S&P, to staples ratio, right at the end of 2021, we were starting to really see this collapse. We set the all-time high at that time in early 2022. Well, this gave us a warning sign that things were not looking all that well, but you couldn't tell the market that. It went on to set a new high later. Well, we were starting to see a very similar thing here. This was starting to really collapse as the market was getting more defensive. Now we're seeing this really begin to improve again. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now, the negative side. People are just not real happy. If you own a portfolio and you like that it's going up, you're probably a little bit happy. But when you ask people about how do you feel right now, how do you feel about the future, there's so many changes going on right now that people are unsettled about things. And so we're seeing consumer sentiment really going down here. And we're seeing a bit of an improvement, but it's still negative with the individual investors. They were down here for 10 weeks. I think that's what it was. It's so long, I forgot the actual number. Now they're starting to get more positive. So they are improving with their sentiment, but they're still below zero. This is a chart that I mention every day in the daily video, but I don't show it. I only show it either in this video or the deep dive video because we don't get very many signals with this chart. This is a long-term oscillator, the special K, and we're improving, but we're still below the red line, so it's still negative. Now, this is a little bit of a concern. When we were starting to go back up, there's a thing called the Zahorchak method, where for most of 2023 and into 2024, we were getting full 10 signals here. That's a full buy signal. Well, when we started coming back up with the S&P, first of all, we dropped down to 8. And then after Friday, and actually it's after Thursday, there's a one-day lag with this chart. We dropped all the way down to 4. Now we're still positive. And you can see other times, if you remember what happened during various times when we had really low readings. This is the great financial crisis, and then we finally came up out of that. Here is the dot-com boom and bust. 9/11 happened right in here. Well, we just want to keep an eye on this. It's not turned negative, but it is dropping. And so if we continue to fall, now we're still positive, it won't actually turn negative unless we drop below zero. So I look at this chart every day and watch the daily videos, and I'll be updating that. Home construction, improving, but not improving like some of the other charts we looked at. It is turning back up a little bit. This was one of the first areas to really fall apart in late 2024. We really saw a breakdown here. And then it was the market that kind of followed after that. We set the new high back in February. This was actually flashing warning signs even before that. And it still isn't necessarily turning positive. We are improving with the semiconductors growth to Dow value ratio. It's coming back up, but you can see we're still setting a series of lower highs and lower lows with this overall ratio. We want this to continue to go up and get back up to the blue line. Semiconductors improving. I could have put these on the positive side, but I needed something on the negative side right now. We're actually reclaiming both of the moving averages with the Dow Jones Semiconductor Index above the moving average with the SMH Semiconductor ETF. Here's another look at the SMH ETF. We're coming back above the rainbow. And then we want the semiconductors to outperform tech. We want them both to do well. But when the market's really positive, like we saw in early 2024, it's when the semiconductors are outperforming tech, and tech is doing good all by itself. So this ratio going back up would really be helpful. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then the areas that we're watching, keeping an eye on jobless claims. And we've been pretty much range bound lately. The moving average is still going up, but we haven't really changed all that much from week to week. If this really starts to go up, then we're going to be more concerned that we're going to go into a recession. And we're watching that same basic thing. The moving average is going up, and we saw a big tick up a week ago, but then the reading came back down in the latest report that was released, and we're back into this range that we were in. But if this really starts to go up, that might concern us more, that we'll head into a recession there. Here's where I plot in red the initial claims, blue are the continuing claims, and then the latest unemployment rate, 4.2%. And we are coming back down on Friday anyway, even though we closed at the high for the day. We're a little bit concerned with interest rates going back up. Now I've got this in the watching section because interest rates were going up all this week and stocks were screaming up too. Well, when we got above that 4.5% level, which on this chart is at 45, now the market's starting to go, hey, wait a minute. We don't like that interest rates are above 4.5%. Now, that's just a relative number. Other times in history, it could have been 5 2/3%. Or if we were the lower reading, it could have been 2 3/8%. Who knows? It's just 4.5% has seemed to be kind of the area where stocks are going up, and then interest rates go above 4.5%, and they go, wait a minute, we don't like that interest rates are going up. I'm going to sell instead of buy. Well, that was a problem. And then we dropped down on Thursday and then continued to drop on Friday, even though we closed well off of the low there. So we're going to be watching that. And then we're watching the relationship between different parts of the market to see, are they concerned about inflation and interest rates? And when this ratio is going up, that means there's uncertainty about inflation and interest rates. Well, we've been just kind of chopping sideways. We're actually in a downtrend with this ratio. We're in a downtrend with this other ratio, looking at TIPS, which are Treasury inflation protected securities. They adjust for inflation and interest rates. That's what people get into when they're worried about inflation and interest rates going up. Well, that's not really what they're worried about now, even though we have bounced back up lately. Seeing a little bit more of a climb here, still in an uptrend when we look at the TIPS to 7 to 10 years, but it's not really showing that the market's all that freaked out, at least yet. We want to keep an eye on the 10-year to 2-year yield curve. That's back to normal. And when this goes back to being normal after having been inverted, that's usually when we start to say, okay, we're watching more closely now to see if we're going to go into a recession. Then I also watch the 10-year to 3-month. That is right on the border between inverted and uninverted. We're not inverted right now, but we've just been kind of dancing around here, going up and down, up and down. So we'll see if this continues to go up. We'll also be watching that to see, okay, now we watch our recession charts. And on the website that I have, I don't make this video public. I do recession updates from time to time, kind of on an as needed basis. And then we're also just keeping an eye on this. This is the gold to SPY ratio, where we set a high back in 2016, another high during the COVID crash in 2020. Well, then I drew this trend line down here. Actually, I got this idea from Chris Shavako from Shavako Capital. Well, we came right up to this trend line again, and we've been declining since that. Does that mean, you've got all the gold people that no matter what's going on, gold is going to go up, even if it goes down. They still say it's going to go up. And they say stocks are going to go down, even if stocks are going up. Those are the perma bears that I like to rag on. Well, now they're just saying, buy the dip, buy the dip, buy the dip. Well, if this really turns into more of a decline, buy the dip could turn into buy the loss. But anyway. All right. And then every day on the YouTube community tab, I can't do this on Rumble, I update intraday pivot points. And we know this ahead of time. These are the pivot points for Monday. The market hasn't even opened yet, and we know what these levels already are. And you can go back and look at this chart and see other times when these are pretty accurate. And I use a 10-minute intraday chart. That's something that I freely post there that you're more than welcome to check out. We want to keep an eye on oil. It hasn't really been rising all that much. It's actually still in the lower 60s. And then the dollar's been bouncing back up, even though it's still in a downtrend. We still want to keep an eye on that. German DAX coming back, setting an all-time high. Isn't that cool? All right. And then we've been looking at a ratio between U.S. stocks, the S&P, and the German DAX, where this was really going down. This is why people were taking their money out of the U.S. market and getting into, let's say, European markets. Well, they started doing that right about here. Okay. Really, is the party over? Now we started to spike back up, and now we're coming back down. This is just something that we want to keep an eye on as well, but I don't use this to make decisions. Thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.